Hi, hello, and welcome to the latest episode of Stock Spotlight, your weekly stock market recap, proudly brought to you by FinMeUp. Today, Higgo and Paul will give some insights into Gemfields, Capitec Bank, Discovery, and Remgro. Enjoy!
Thank you very much, Ingrid. Let's jump straight into it. The first company is the small cap of the day, and that is Gemfields. So they released their results. Revenue decreased, net profit decreased, earnings per share decreased, yet the dividend per share increased. So Gemfields is quite a unique company. They are in the stones. So if you like the emeralds and the rubies, the flashy things, this is a company you should look at. They are sitting on quite a lot of cash. They've got a healthy balance sheet. We saw them recently buying back their own shares, so they published 2 announcements where they bought back shares, and they still have the possibility and opportunity to buy much more shares. What that will do in the future is actually help their earnings per share grow faster. So if the revenue stays the same, the earnings will actually grow because there's less shares outstanding. So that they're doing that, and they're also paying some juicy dividends. If you look at the share price, Gemfields hasn't done anything the past year, but they are sitting on a juicy dividend of around 20%. So the share price didn't do anything, but you got some proper growth just from the dividends. So, Paul, let us know what you think of Gemfields. They are sitting on quite a lot of cash. The revenue is down, net profit is down, earnings down, but dividends up. What do you think of this company? Is this maybe a company you put in the bottom drawer, just get the dividends out of it? Or is it just something that you make your money elsewhere and go buy a ruby with that money?
Good question, Higgo. I quite like Gemfields. I think Gemfields presents a nice opportunity, especially for a small cap on the JSE. This is a stock, of course, with a lot of upside potential. You also take risk, remember, but you have to weigh the bullish and the bearish cases. So for me, the bullish cases are, firstly, people love diamonds, and they always will love diamonds. And now, recently, there's been quite a push towards emeralds and rubies. So that's good. Secondly, we as a collective, people in the world, we are getting richer. And especially the middle class in developing countries such as China and India, they love emeralds and rubies. And that middle class is getting bigger and bigger. So I think the demand will always be there and even increase quite exponentially over time. And then lastly, it's a cash-heavy small cap. So if you want to take some risk and you want to, place your bets, I think Gemfields might not be a bad place to place your bets. But then obviously there's bearish cases as well. Firstly, the recent auction. So how it works is every 3 months there's an auction. They extract all the emeralds and rubies from the mines in Mozambique and Zambia, and then they have this massive auction where they sell everything. And prices and the quality of these emeralds and rubies change over time. And the recent auction hasn't been too great. So the prices were a little bit down. So that's a little bit of a coin flip. You never actually know what you're going to extract from the ground in terms of quality and quantity. And the second thing is in Mozambique, where the one big mine is, there's this one, let's call it party or political thing called the jihad. And these people are actually against the government, and they're fighting the government, and it's quite close to the mine. So you can now think to yourself, if this thing gets very close to the mine and the security isn't great, then that mine can be compromised. And that will have a significant impact on Gemfields. So I think that's why it's even trading at such a low PE, because investors are cautious. But I don't think it will play a role. I don't think it's going to actually impede the mine. So yes, I like Gemfields. Let's see what happens.
Definitely going to be interesting to watch. There are uncertainties, but there are also bullish guys. This is a perfect, you don't know what's going to happen, and you really need to do your own research and trust your own instincts, I guess. The next company is banks. We're going to look at 2 banks. The one is not really just a bank, but we've seen the name, and that is Capitec and Discovery. So Capitec, obviously, they've been a gem the past 15 years. If you own shares, you made a lot of money, and they've been executing just incredible since the start. But now they're obviously taking shots. Interest rates are high, inflation is high, the consumer is under pressure. So their operating profit before tax increased by just 6%. Earnings per share increased by 9%. And then their dividends increased by 9%. So there is growth. They're not going backwards. There is growth. So well done. the thing is, okay, so let's look at Discovery. So Discovery Bank, we all know, launched, and they're now around 700,000 clients, and it's more upper class clients, and they've really done a lot of marketing. Their normalized profit, this is Discovery Limited, not the bank. Their normalized profit from operations grew by 24%. Earnings per share fell by 5%, and the net asset value grew by 19%. So, it's two very different companies. Capitec is just a bank, and obviously they resell a few things. And Discovery has got a lot of things going on. Discovery, in my mind, it's a little bit of high growth. I think if they were on the NASDAQ, you would have seen a lot of action and Kathy Woods of this world speaking about Discovery, because the bank is innovative. It is really, really innovative. The rewards, they're putting really a lot of money behind it, and we're seeing the growth. But it is still, looking for that profit phase. So it is still early stages for Discovery Bank. But overall, good results from Discovery, and their share price have shown that. The past year, the Discovery share price performed really well for the owners. Capitec, on the other hand, they had their years of real good performance. But now you're seeing bad debts creeping in. They are priced to, not perfection, but really highly priced. From all the banks, their growth is, so to say, the slowest in recent times. But they are priced the most. Like the PE is 20, where Discovery, that's got all this exciting stuff, and the insurance and all that stuff, they trading at a PE of 18. So the Capitec is expensive. The share price hasn't been doing anything really. It's been going down a little bit, if I'm not mistaken. And Discovery, on the other hand, is going up. Paul, what do you think of the banks? We've spoken about the banks a lot. For me, I'm actually picking Discovery. Just because, there is a bit of high growth. There is lots of room for further expansion in a client base that, they have a bit more money, so there's less risk with the debts and so on. And they're also making partnerships left, right, and center. So they announced they are doing, or going to launch the home loans. They announced the Checkers partnership as well. It's just feeling like incredible. What am I missing? Why is Discovery not just a good investment? Because obviously there's been financial, I know you're a smart guy and you struggle to read the financials. So Capitec versus Discovery versus the other banks. What do you think?
Yeah, you're making me choose. I actually don't want to choose. Let's talk about Capitec and then Discovery. So firstly, Capitec. We've spoken about Capitec before. I feel they're way too expensive. Yes, they once were this new kid on the block, and they catered to the lower class South African market, and they made a killing. And now they have about 20 million people that's banking at Capitec, which is actually incredible. So a massive success story in South Africa. But now we have to assess it from an investor's point of view. And for me, trading at a 20 PE compared to the other banks, they've already have 20 million people. So I don't see why this company is trading at this valuation. Of course, their ROE, return on equity, is very high. And this is one of the most important metrics when it comes to banks. So that might be a reason. But for me, they can't really increase their chunk of the pie in South Africa. I think they've pretty much hit the limit, or maybe they can, but not a lot. So if you want to grow, you can't grow your piece of the pie, but you can grow the pie if you now expand into Africa and other markets that you have not yet delved into. So that is potential for Capitec, and it's a great business model, especially for Africa. Low banking fees, low banking, whatever they do. And they have plugins with a lot of companies such as Easy Equities. The banks overall are under pressure, like we've mentioned, high interest rates, inflation, people are defaulting on their loans. So banks as a whole, the sector as a whole, doesn't excite me at all at the moment. In fact, I'm actually quite bearish on it. So I won't touch Capitec for its valuation reasons, as well as it's a bank. I don't think it's gonna do very well over the next year. Next is Discovery. So Discovery has this amazing whole ecosystem going. They have Vitality with the gamification model. They have Discovery Health, like the medical aid, and the insurance products, and now they have the bank as well. So they're becoming like a full Monty in financial services. They put a lot of money behind this bank, their new bank venture, and they were obviously massively loss-making because it was very little income for very high expenses. This year, much better. Still loss-making, but lesser so than last year. So yes, I think Discovery is better than Capitec in that regard. It's also very exciting, but it's trading at 17 PE. But like we mentioned last week, insurance, I'm scared of. Like, insurance doesn't excite me in this company. It's quite saturated, and you saw what happened once again with the floods. If you're an insurance company in South Africa, you took a hell of a beating this weekend with all of the floods in the Western Cape. But for Discovery specifically, they have a global footprint and they want to expand. And this is what excites me. They own like 25% of Ping An, which is a large healthcare provider in China. So there's that potential. And it's an aging population. And what I like about the aging population and a population that's increasing in value, you as a healthcare provider can really tap into that. So there's potential. But I honestly won't choose one of these companies. If I was an investor, it's not obvious for me. Neither Capitec or Discoveries are obvious buys for me.
Yeah. The thing about the banks and any company for that matter is once you've reached absolute scale, then you have to like really be efficient and either just generate more profits from the revenue you're generating, or you need to enter new markets, or you need to sell new products. And I think that is something Capitec is getting into. We've seen with data and there's obviously projects going on there. So, I mean, as of to the management, I think their management, if they are going to enter new markets or new products, I'll definitely be on the lookout for those. So very interesting to watch. All the banks, we've seen Bank Zero, we've seen Old Mutual wanting to launch their own bank. We've seen Time Bank, all these new banks. It's a very exciting space, lots of competition and lots of things to look out for. Final company, Remgro, headline earnings per share grew by 8.9%. Ordinary dividend grew by 60%, and that's obviously because there was a transaction with Mediclinic, so there was more cash. And their intrinsic net asset value per share grew by 16.6%. And the transaction fees for Mediclinic was obviously contributed to the earnings per share. That was a bit lower than the headline earnings per share. But overall, Paul, what do you think of Remgro? It's obviously been a giant over decades, and the management have really done a lot of good things and cool business things in their lives. What do you think of Remgro at the moment in time?
Yes, Remgro is at a very exciting and weird stage in their cycle, their company cycle, because they are now changing their business model a little bit. So many changes over the last 2 years. They've basically gone and restructured or re-strategized their whole outlook on this whole thing. They've gone and they said, we want to be a channel for investors to invest in unlisted companies, not a combination of listed companies like a normal holding company. Much like Sabvest. Sabvest is mostly unlisted companies, 90% unlisted, and now Remgro is doing the same. So we are going, if you invest in Remgro, you're going to invest in unlisted companies, and there's a way for you to now get exposure to companies that you normally won't be able to. So I think that's a very cool business model, because I think there's a massive demand for that. Can they execute? That's the question. And thus far, over the last 5, 10, 15 years, they really have. But it's been with listed companies. So let's see if they can replicate their success in the unlisted space.
Interesting. Thanks for the insights, Paul, and thanks for watching. Once again, remember, Stock Spotlight every Friday. If you haven't subscribed to the FinMeUp newsletter for extra insights and educational pieces, the link is in the description. There are more links in the description that you might really find value in. Have a great day. Cheers.